Welcome, dear audience. It's just been Christmas time. I hope you enjoyed whatever you could do during the Christmas. I know that the pandemic has also given us a lot of troubles in how many people we could meet. But nevertheless, it's a pleasure because here during the holiday season we have had the opportunity to talk, or we have the opportunity to talk to some really interesting people. And today I am going to talk to Ken Stack, who lives in the US. And Ken, maybe you can tell a little bit more where you live and what you do, because you know that better than I do, right?
No problem. Thanks, Morten, for having me. My name's Ken Stack. I live in Ann Arbor, Michigan. I've been involved in digital printing for about 3 decades now. First as an engineer many years ago. Started a few inkjet companies. The last one was a company called Jetrion, which was focused on the digital packaging space. I sold that company to EFI in the 2007-2008 timeframe. Worked at EFI for their management team for 4 or 5 years. Attempted retirement, which didn't last as long as I would have liked. I'm a horrible golfer, so that didn't help. And in 2012, I started a small boutique M&A firm called Proximus, which is really focused on strategic M&A within the digital printing industry. Since 2012, I've done almost $1 billion worth of inkjet deals within the digital printing industry. So it's been a fun ride, and it's been interesting to see how much the industry has changed over the years.
Fantastic. And I got your resume just a couple of hours ago because we have not met each other before, and I was, as I said to you, almost starstruck because the resume you sent me. Because when I asked at LinkedIn just before Christmas about people who knows about M&As, I didn't expect to have people that both knows about M&As and the printing industry, and you are a prime example of this. So let's dive directly into the subject because. I'm a little bit curious because when you have been involved with the M&As that you just described very briefly, has that been on both private companies and public companies, or what kind of companies are you most interested in with your boutique?
Yeah, great question, Morten. So my business has really been on both sides of the aisle, as we say. Whether it's public companies buying smaller private companies, whether it's private companies selling to larger companies. M&A really comes from 2 sides, and they're trying to find a middle, as I always say. And so sometimes, I'm on the buy side, representing usually larger companies trying to acquire smaller entities. Sometimes I'm on the sell side, representing smaller companies selling to larger companies. So vast majority of deals within the digital inkjet sort of industrial space have really been what we call strategic acquisitions. And I saw you had another fellow on who's a investment banker about a week ago or so, who talked a lot about the difference of financial M&A versus strategic M&A. My business is almost solely focused on strategic M&A. And what we mean by that is there's many private equity companies out there that are looking to buy any sort of company that they think is a good financial deal, really in any market. They don't have a strategic focus. And those are called financial M&A transactions. They probably represent the majority of transactions in the world, okay? But that's a very different sort of transaction than I usually do. I'm usually working within a given industry where, say, a large company says, hey, I want to go acquire a certain type of product. I want to acquire a certain type of skill. I want to acquire a certain kind of intellectual property. On the sell side, sorry, go ahead, Martin.
Yeah, could that be, just to make it clear even for me, could it be like, sure, let's say that you're a commercial printer and you want to also do packaging, then you would go to you and say, can we find a match that could actually bring us into that market space, or was that
exactly
a good example?
That's a perfect example. So I'll give you a couple of actual examples. So when I sold Jetrion to EFI, that was a perfect example of a strategic investment. EFI was already a large player in the digital printing space, first in software. They then purchased ViewTech to get into wide format. They then saw the area of packaging growing, so they had a choice. They could either begin to invest a lot of money into developing their own packaging inkjet products, or they could use their balance sheet, right, their cash, and go off and acquire a company that was already there, right? And so they, at the time, chose to acquire Jetrion. That's a very common theme in our industry over the last 5 or 10 years, where you have these large companies with a lot of cash saying, hey, is it better for me to go invest the money to develop a product and a market and a channel, or should I just use the cash on my balance sheet to come off and buy something that's already running with a team, with intellectual property, with product. And most publicly traded companies, in particular, are very, very focused on their earnings per share. Well, the great thing about M&A is it doesn't impact your earnings per share, does it? If I'm going to spend $10 or $20 million developing a product, though, over a few years, that directly impacts your earnings per share.
Oh, yeah.
When I use my balance sheet and simply acquire a company, well, then it's actually helping my EPS, not hurting it. And so that's been a big driving force over the last, I would say, 10 years.
And I think that without knowing very much about M&As and that side of the business, I think that it's also it's a fast track to basically achieve the consolidation that the industry sees anyway, right?
Absolutely. When I started Jetrion, there was probably 10 or 20 small companies running around. It was a young market, digital industrial printing. Whether you were in packaging or textile, there was lots of family-owned companies, lots of venture-backed companies. Now, with the consolidation that's happened over the last 10 years, there's actually too few targets, right? The problem now today is when I get phone calls, it's usually I don't have something to sell because all of those companies, people like myself and others have either acquired them or vice versa. So the market is very different, and it has really consolidated, but there's still a lot of room to consolidate as well. Okay, there's lots of new vertical markets showing up, like 3D print and other things. Textile is still consolidating. Packaging is the next big one where people are really interested in what's happening there next. And so we'll still see a lot of consolidation within the industrial digital print markets.
Before we go into some details I would like to talk to you about, I have a question, and you may think it sounds crazy, but I ask it anyway.
It's okay.
In your views or your opinion, do you find, or is it possible at all to have easygoing acquisitions, or is it always a struggle?
I'd love to tell you they were all easygoing. It really depends on the deal. So, and I will draw a distinction again between, financial buyers and strategic buyers. So financial buyers, they run a pretty harsh deal. Okay. If you're a private equity firm and you're out acquiring companies, your sole goal is to buy that company for a great financial deal. Okay. Either, cut costs, try to grow it, combine it with something else and then resell it. So those deals tend to be the toughest. When you're on the strategic M&A side, there's always arguments around price and things like that. Okay. And the reality, though, I'll tell you, Morten, is on the strategic side, price is really usually not the issue. It really isn't. When I'm representing, say, a large buyer, they're most interested in making sure it's the right fit. Okay. Does this company really have market leading products? Do they really have an advantage technology? Do they have, a moat around their tech so that others won't compete very well over the next, 5 or 10 years? And so a strategic M&A process usually first focuses on what's the strategy? Is this the right fit? Is it the right culture that we're acquiring? Then in terms of the actual deal, price, I will tell you, yeah, okay, we're all going to argue over the price because it's important. But really, and I tell this to all my clients, buy side or sell side, when deals don't get done, it's usually not the price, it's usually the terms, okay? And this is the part where people really kind of struggle. So if you're going to sell me your company, sorry, go ahead.
Yeah, no, that's fine. But that also leads me to because one thing is when we talk about the price and we talk about the fits, but I could imagine, and maybe that's wrong, but that if you have like a financial M&A, then it's as Sean Kavanagh we spoke about with last week. He said that it was very much about having a cash deal because it's like, making sure that the company is having as a high price as possible for the seller and get the money so he can get out of it. I take that if it's a strategic deal, it could also be maybe more relevant to have some kind of earn-out or some kind of incentive payments, because you will then have at least an incentive to make sure that the deal goes on right?
That's very true. I would say I have a huge deal data set that I track all the deals within the industrial inkjet markets. And I would say probably 30 to 50% have some sort of earnout. Okay. And for those reasons, usually if the small entrepreneur says, hey, look, my company's worth a lot of money. We're going to grow very, very fast over the next 10 years. And here's a hockey stick in terms of revenue. And as a buyer, particularly as a large company that might be more conservative, might say, look, I can't I can't pay you today for future earnings. Plus, as you just said, I want you really incented. So let's work out some sort of earn-out scheme where, let's say, half the money's up front and half is dependent on performance. Now, the hard part here, Morton, though, is that it's very hard. Okay, it's very, very hard to strike those deals from a contractual perspective because, when you're the buyer, you want full control afterwards. But when you're the seller, you say, hey, wait a minute, what happens if you cut my budgets? Yep. Right? What happens if you don't deliver the extra sales channels that you promised so we could grow together? What happens if you say, hey, Ken, wait a minute, don't sell into that market. I've got other products there. So yes, earnouts happen all the time. It's a great way to bridge a gap in valuation. It makes sure that the sellers continue to be incented. So there's a lot of good ways to do them, but I will tell you that's probably one of the more tricky things to do. And as you said, financial deals, I would generally completely agree with your prior guest that on a financial buyer deal, I'm not too excited by an earnout. Okay. Mm-hmm. On a strategic deal, I'm much more open to it as a seller, but they have to be crafted the right way. And everybody has to be very upfront about how are you going to run the business afterwards.
If you, I agree with you that, and I understand totally what you say about the pricing is maybe less important if you have the right fit. But, one thing is saying that I take that especially the seller has a huge interest in getting the most out of the work of the company. So, let's talk about pricing. How do you normally go into that process? What kind of let's say that the fit is maybe not so much the company and its products, but more the technology, for example, right?
Mm-hmm. Then what? It's a great question. Phenomenal question. So valuation is always the first question that always comes up, particularly from the seller side. Values are something that two people agree to, I always say. Now, having said that, there are some normal valuation metrics, okay? On financial deals, as your prior guest had talked about, they're usually based on, some cash flow kind of projection. I will tell you on strategic deals, that's absolutely not true. Okay, when you're a small company, you're growing very rapidly, you may have losses, right? You may have no earnings. But the buyer sees that as something very valuable because they say, hey, I really like that product with my sales channels. I can triple sales, right? So that's a huge value to me. So how do we value those deals? Well, if you look in the market over the last, say, 8 to 10 years, typical valuations in the industrial inkjet space are anywhere from probably 2 to 3 times revenue. Mm-hmm. Revenue, not earnings. Now, there's a very wide distribution to those. Okay, things that are growing very, very fast, things in the software space, things in the ink space that have tremendous margins. Those may sell for 3 or 4 times revenue.
Yeah, because I was just about to say. Because I was just about to say that when you say the earnings, and if you look at some of the, if it's more like a strategic kind of thing, it can also be because of the scalability of the product, right?
Absolutely. Yeah. So software and consumables scales very quickly, right? And all of the profit tends to drop the bottom line. So those are sold for higher multiples. Systems companies, if you've got a very strong, fully digital growing system company, multiples are anywhere from kind of 1.8 to 2.3 times revenue. The tougher ones to sell are more of the component companies. People say making electrical boards or providing integration services. Those are more around 1 times revenue. But if you look at that range, so it's a huge range, anywhere from 1 to 4 at the edges of the range. But on average, if you just ask me, hey, Ken, if it's an industrial inkjet company, what does it sell for? 1.5 to 2 times revenue is a pretty reasonable range. Now, if you look at that, you say, wow, that's actually feels like a lot. If you compare it to other tech markets, it's really not. It's right in the sort of the norms. If you look at norms for software acquisitions, it's 2 to 3 times revenue outside of our space. If you look for robotics companies and things of that nature, other high tech machinery kind of stuff, it's all kind of in the same range.
But can't help think about that if you are a startup and you have like an exit strategy, finding a strategic buyout partner, I could assume that you could have an incentive to focus more on your sales and your top line rather than on your earnings, right?
Yes. I will answer that with an absolute yes. Yeah, of course. But I will tell you this too. People like me do pretty good due diligence, right? And
Okay.
so buyers are not stupid either. Okay. So whether you're hiring me or someone else, don't kid yourself, right? People do pretty good due diligence. If you're a buyer that's already in the market and someone's just jamming a bunch of product out there at no margin and got lots of returns and service cost, you're going to find that stuff. One of the things I tell all of my clients, okay, particularly on the sell side, is do not lie, right? Do not lie. The other side will find it, okay? When I'm on the other side, trust me, it's
You'll
pretty
find it.
extensive, okay? We'll find it, right? So the reality is that, yeah, you can always play a little bit of games, right? But they're at the margins because people do understand. If you're a strategic buyer, you know the market. You're talking to, as part of due diligence, you're going to go out and talk to customers. You're going to go through every little bit of the financials. You're going to make sure, right, that these sales are real. You're going to make sure that they're scalable, right? And so I would say that, yes, you can certainly try to do that. But, at the kind of multiples we're talking about, a little bit of money here and there is not going to make that strategy worth it. Because as soon as you find that, that's when the strategic buyer runs.
Okay.
Right. As soon as they see that, that's when they run. And that's a really important distinction here, right? Their main concern is not the price, right? Is this thing scalable? Is it going to fit? Can I grow it? Is it synergistic? It's not, hey, I want to save $500,000 or $1 million. Not the problem.
No. It is funny because one of the things that was one of my takeaways from the conversation I had with Sean last week, and you will laugh at me because that just shows how unprofessional I am. But I have done my budgets year over year, and I always use them to say, okay, here is my cost, here is my expense or income and out and expenses, and then it has led me to some kind of profit, hopefully, right? But as he said, it's actually more interesting because the way he expressed it was also the fact that it maybe more gives the buyer an understanding of how accurate you are in your own predictions, right? Does that also apply, in your opinion, to when you do strategic buys? Because, I mean, if you buy the technology, you don't really care, right? But if you buy the company also for adding it to your product line, it may be very relevant for you to see where things are developing, right?
I totally agree. I'm going to say yes, but so the answer is absolutely. So when I'm doing due diligence for a buyer, okay, and I'm looking at 3 or 4 smaller companies, one of the key things I look for is, are you under control? Do you have a budget? Do you have a process? Whether you hit it or not, come on, I've run a lot of companies. And how often do I hit my budget, right? I'd love to tell you once. Okay, not true. Okay, so I'm less worried about did you hit your budget, but did you at least think about your budget? Yeah. Because let's face it, when a small company gets acquired, they now have to fit into the larger company. Okay, if they don't have any process and they're just kind of running out of control, how well is that going to go afterwards? Well, probably not too well. And if I'm paying a big multiple, right? If I'm paying you a whole bunch of money and your company's actually losing money and we got to scale it to make money, or maybe it's barely breaking even, if you don't have good financial controls and some level of strategy in place, wow, your tech better be awesome, right? And that's usually not the case. You're usually buying not just, there's very few patents that are worth so much money we're all going to come in and spend the money. It's not the medical device field or something, So in digital print in particular, you're usually buying the team and a head start.
Precisely.
Right. And if there's not some sort of credibility factor there that this team can continue to scale, I'm probably going to suggest to my client, hey, post deal, this is going to be a disaster.
Yeah, or maybe, as also Sean said, maybe spend some time on maturing the company that you want to acquire before you actually get into that process, right?
Or you wait. Yep, sure. Or you wait.
One thing I would like also to know, because I think that in the past year, 2020, with the pandemic, I think that a lot of things have turned up and down in all industries, including also mergers and acquisitions. I know from one of my friends in America that in the beginning of the pandemic, there was like not so good to approach too many because it was like taking advantage of a sad situation. But that soon changed because acquisitions can be good for both buyer and seller in order to get the market share. Have you experienced in the US or in your market space there has been a renewed interest in merging or acquiring companies in order to grow faster?
Yeah, I would agree with that. So if I go back to sort of February, March timeframe when the pandemic started. So first, M&A in general in digital inkjet has actually been pretty aggressive over the years. The market's been consolidating. We're doing, I would say, between 8 and 10 deals a year just in industrial digital print, which is quite a lot for an industry that's a few $1 billion. So that's interesting. February hit, March hit, things got pretty quiet, right? People were pretty nervous. And if you look at the buyers that are in this market in particular, 5-10 years ago, it was big publicly traded companies, the EFIs, the Dovers, the HPs. They're out pushing acquisitions. Well, that's changed now, right? Even pre-pandemic, right? EFI got bought by a private equity company, Cirrus. Dover's kind of changed their acquisition strategy. HP hasn't made an inkjet acquisition in years. The buyers have kind of changed. The buyers now, there's some private equity interest, but there's also the large Japanese companies, right? If you look at the large office conglomerates, they're now moving into industrial. They are much more
like the Mitsubishis and like the Fujis and these kind of companies.
Yes, exactly right. Yeah, Fuji and Ricoh and Konica and all these companies. So they, particularly being Japanese companies, they're pretty conservative to start with, while the pandemic made them even more conservative. Okay. So February, March, April, May, efforts around M&As certainly started to shrink.
Should have been holiday season at that time, right?
Should have been holiday season. Yes. For me, it was holiday season. Exactly. After that, though, the exact opposite happened. Okay. So people then began to feel more comfortable, particularly early in the summer. Interest, I think, has grown quite a lot, back to even where it was, if not higher now. The other interesting thing it did was, as I had mentioned before, at least in my little markets here, there's actually not enough sellers, right? I get more buy-side phone calls than I do sell-side. Well, COVID scared a lot of smaller companies that were not interested in selling, right? When you get no income for February and March, which a lot of them literally had no sales, zero. Even ink stopped, which is shocking, right? That got a few people thinking, hey, I'm 50 or 60 years old now. I'm not sure if I'm going to pass the, what do I do? Okay, I'm through that now. That's great. But maybe having a plan here is something I ought to do. So it's actually, I think, going to bring some new sellers into the market. I think that, from the buy side, people are feeling a lot more comfortable. The office is still a bit of a disaster, as you could probably imagine. People that make most of their money off of copiers and office equipment are going to struggle for a long time. So we'll see how that shakes out. However, central banks continue to flood the world with money, right? So now we've got private equity buyers and private company buyers. You saw BOPS acquire the rest of their Movement JV recently, right? So you've got, whereas 5 or 10 years ago it was 100% pretty much public companies doing the buying. Now it's kind of 50-50, which for me is a big change. And I think you're going to see a lot of increased interest actually post-COVID.
I also find what you say interesting from the perspective that we have actually, you can't know because we have not, this is the first time I tell anybody, but on February 15th to 19th, we have Learn With Us session about inkjet. And one of the reasons why we're doing this is, of course, because a lot of new equipment and devices are brought to market, but also I would say in the past year, maybe 1.5 years, for the first time ever, I think that digital print and inkjet have now started to, have the nose for taking the bigger markets of commercial print and labels in big scale. So I think a lot of PSPs are now looking into this. So I think that for what you just said about the big Japanese and the big private companies looking into these acquisitions is a perfect timing, because if there is a shift, it is maybe just about now.
Yes, you're exactly right. So up till now, I would say most of digital print was kind of on the margin. It was ultra short run, right? It was taking advantage of sort of this issue of, hey, I'm going to produce only one of something, right? Sort of large scale personalization, we'll call it.
Yeah, mass
Now
customization.
the economics have changed, right? The running costs have come down, and it's allowed all of these digital print technology, whether it's inkjet or toner, to begin to move up in the volume markets, right? So now, hey, it makes more sense now to do a medium volume job, not just a low volume job with digital. And that's going to continue to change, right? As the costs come down, right, the larger, they can go after large parts of the market. So I think it is a great time for that. That's happened because the technology has matured, right? The volumes have gone up, so it's allowed the producers to produce equipment and consumables at lower prices. And so I think you're going to continue to see that. So I expect that the transition is going to continue quite a lot. The other thing, too, is this whole area around personalization is really important. You know, you look at the Etsy's and the other things, and so how does that affect our little markets? Well, I'll tell you, one of the fastest growing markets where I do think you're going to see a lot of consolidation in the printing and inkjet side is around direct to garment and promotional and sort of crafting stuff. You know, there's thousands of people now trying to make a living in their basement with little sawgrass printers and things like that, producing all sorts of stuff that COVID has really driven forward. Yep. Right. And so there's lots of areas. While COVID certainly hurt our markets, particularly back in January, and let's face it, you don't want to be in the business of potentially producing billboards for trade shows right now. That's going to be a rough market for a long time. But hey, if I'm in the short run T-shirt market or promotional goods markets or the floor graphics markets or the packaging markets, hey, I'm actually being accelerated by this change, not slowed down. So I think you're going to have winners from COVID, you know, and then you're going to have losers from COVID, and we'll see how that shakes out. But net, digital print wins, no debate.
And I can't help think about when you mentioned also the garment that if you look at Amazon, I think they are a pretty big investor in Kornit. So yep. I think they have seen that as an opportunity also for having. Copies down to one, basically, also of yes. Textile, right? And that is basically yes. a trend that is maybe not so much about mass customization, but more about having faster access to the goods rather than having them mass produced and put in a warehouse, right?
Exactly right. It's about local production. Okay. Yeah. It's about not shipping everything everywhere. It's about not having overruns where I'm stuck with the wrong size and wrong color shirt and we're throwing, you know, if you look at the reason, the textile market in general, whether it's direct to garment like a Kornit or a Sawgrass or a Brother or somebody like that, or the wide roll stuff, you know, MS and Reggiani and these companies that are producing wide roll but short run fabrics. Mm-hmm. You know, that market has been the biggest part of the inkjet consolidation now for the last 5 years. Okay. Mm-hmm. And it's a very, very profitable market, growing very rapidly. And the reason for that is because the supply chain on garments is ridiculous. It's months, you know, when you design a new, you know, garment, it's months before it would show up in the store. Now, with these technologies, now it's weeks. You know, if you look at the Zaras and these other companies called fast fashion, you know, they've driven a lot of this. Well, the Amazons and the others are now taking it to the next level. And I think, you know, from a production perspective, it has to be digital. There's no analog choice there.
That's true, but I think that is also because if you look at textile in general, it's still a very high margin business, right? So even that the cost is maybe more expensive on digital at current time,
sure.
You can better afford it than if you have a commercial print where the margins and the difference between offset and digital still is significant. Well, we had to change a little chapter here because I'm very curious about another thing I would like to have your brain around here. Communication. When you go into an acquisition or merger or any process in that relation, can you tell me a little bit about what do you communicate to whom and when? And if you are, let's say, a public company, what kind of information are you obligated to give?
Great question. Highly depends on whatever regulatory environment you're in. Every country has their own set of rules. But as a general statement, usually as you're doing things like due diligence, you communicate absolutely nothing. In fact, most of my clients internally, when I'm on the buy side, okay, they'll actually make their own internal employees sign an extra NDA or something saying you're not going to disclose it, okay? Because it is, hey, if you're representing, if you're either involved or like me potentially working with a publicly traded company, it's a zero tolerance policy, okay? That's serious stuff because you know the stocks are traded. after when a deal is being done, though, I think one of the key things to realize is that there's signing and closing, and those two things are very different. Okay, when we're used to selling something, it's closing, meaning okay, the deal is closed. You officially own it. You've given me the money, and we're done.
Concludes the deal, basically.
Right, it concludes the deal. Signing is something in between. I'll give you a good example. When you sell your house, very often you sign a deal for your house, but it's contingent on something. It's contingent on the buyer having financing. It's contingent on an inspection. It's contingent on making sure a title, lien is done or a search is done, right? So the same kind of things happen in deals. And so I think that sometimes you'll see deals communicated when they're signed, but they're not closed. And I would say 50 to 70% of deals, they're signed and then later closed. And sometimes you announce them at signing when you feel very comfortable, and sometimes you wait until closing. And it really depends on, the nature of each deal to tell you exactly which one would be, be appropriate.
The reason I'm asking is because if you are a public company, you basically operate your company on behalf of your shareholders. And I would assume that if you let's say that you want to buy a strategic deal and you want to buy or sell a piece of your company, that could influence your shareholders' opinion about you as a company. So therefore, I would assume that there was a high level of integrity in actually disclosing as much as you can without disclosing details that can damage either party.
Usually, things are not disclosed till they're at least signed. Okay. Sometimes, particularly for much larger, multi-billion-dollar deals done by Goldman Sachs, stuff leaks sooner or later. So when there's a leak, the company has to respond. Yeah.
Or when Xerox announces that they want to take a hostile takeover of HP, for example.
Right. Yeah. That's a completely different kind of situation, right? Now, those are the more rare situations than they are.
Fortunately,
the
right?
Norm. Yeah. Fortunately, usually when a public company is buying, say, again, doing a strategic deal, usually with a smaller company, they're not going to say anything until the deal is at least signed, and they're very confident it's going to close. Very confident, because, like you said, it influences the share price, right? Which is, if you give inside information to people too soon, right, then hey, you're breaking the law. On top of that, though, deals do occasionally blow up between signing and closing. It's rare, but they do occasionally not get done for some reason. So usually you really want to wait until you're very, very sure before you say anything.
Sean told me in the episode from last week again that typically when he was involved in mergers and acquisition, I think that was mainly for smaller, medium-sized companies. He said that often when you sign the deal, either you deposit the full amount on an escrow, or you have a bank guarantee, or you have some other kind of securities. Is that also normal when you have, let's say that you are a public company, you want to sell off something to a private company, or the other way around?
Sure. Yeah. And this is also really important for people to understand when they're thinking of buying or selling a company. So when someone, if you were to sell me, Inkish TV, okay.
You're welcome. It's cheap.
Okay, yeah, there you go. Exactly. We'll work it out right after the call's over. I'm not going to let you take all the cash immediately. Why is that? Well, as we talk about the terms of a share purchase agreement, the price is one component, as we talked about before. The rest of the terms are critical, and we have these things called representations and warranties. So when I buy your company, you're going to represent and warrant to me that you actually own the company, right? That the sales in the past have been X, that you paid your taxes, that you don't have any ongoing lawsuits, or if you do, you've disclosed them to me. If you're a technology company, you're going to say, hey, we filed these patents. We haven't had any patent lawsuits. We have this kind of warranty cost. Well, I'm going to say, hey, Morten, that's great. And I believe you to a point, right?
But I need some evidence, right?
Right. So we're going to take 10 or 20% usually of the money and put it in what we call a holdback. Okay. So you don't get the full check the first day, right? 10 or 20% goes into it. It goes into an escrow account. And that escrow account is very clear. And there's a contract around the escrow account that says, look, if, there's no lawsuits from stuff that you did beforehand for a year or two or three. If warranty costs don't go crazy, if we don't find out something else, in the next X period of time, then you eventually get all the money. It's important to realize, though, that's in an escrow account. I've actually, as the buyer, I've transferred the money. An escrow agent is holding the money, okay? And we've agreed contractually to when you can get the money. It's not, I can't stop the payment of that money, okay, if you're due the money, right? That's the difference.
And is that so? That is the norm when you buy and sell companies? That is
absolutely the norm. I've never done, of all the deals I've done, I've never done a deal without some sort of holdback. And as a buyer, I would never tell my client to do a deal without that, because stuff happens, right? Stuff comes up, okay, that we can't foresee. That tries to cover that. And as a seller, expect that. If you're thinking you're going to sell your company with zero holdback, okay, as a stock purchase agreement, I doubt it. And it is important to understand there's stock purchases and there's asset purchases, and those are very different. Usually when you're selling your company, okay, you actually want to do a stock sale. And the reason for that is that if you just sell the assets, you retain all the liability. The thing is, and as a buyer, you have to understand that as well. You know, if there was something that happened in the past at English TV and you get sued 4 years later, somebody is liable for that. Is it the buyer, right, or the seller? Well, if you sold me the stock, if you sold me the company, the buyer is now liable. That's why we have holdbacks, okay? If you sold me the assets, then you're liable, the seller, right? Because you continue to hold that liable. And that's a really key distinction for people. There's also tax issues and a bunch of other stuff.
Yeah, and that, of course, also influences the pricing, because, I mean, that is part of the risk base that you have in the investment, right?
Absolutely. Yep. Buyers will usually pay more for just the assets in a lot of deals, okay? Very rarely, though, on a strategic deal. I've never done an asset deal on a strategic deal, okay? First off, the seller wants to sell the whole thing, and they want to buy the whole thing, so... But I would say in more of like liquidations, bankruptcies, other kind of deals, then very often assets are used. But usually for the kind of deals we're talking about, it's share purchase agreements.
If you are in a position where you are doing a deal, and will you believe, or will you find that is important information to shareholders to disclose what kind of terms? I mean, for example, there's as you said, let's say that you have a company that are, let's say I'm selling a part of my company, and I basically want you to buy it from me, and it's a shared deal, so you get everything, all the liabilities, everything, and we agree that you pay, let's say, 25% on the hold account. Is those terms on how you pay and how you do that, is that normally something that you will disclose to your shareholders, or is that something between buyer and seller?
It's a great question, and it's usually depending on what we call materiality is what drives the disclosure requirements. So you'll see a lot of deals announced where they don't even disclose the price. And you say, well, how can that be, right? And the argument with the accountants and the auditors are, hey, we don't got to disclose it because it's so small. A big company buys a little company. Okay, it doesn't matter whether it was 5 million, 10 million, or 50 million, right? It just doesn't matter. So you see no disclosures at all. On the other hand, you'll see companies where they disclose all sorts of stuff, right? They disclose the price, they disclose the earn-out terms, they disclose some other inventory issue. It really depends on what their auditors are going to consider what's material. Usually, most buyers want to disclose as little as possible because they don't want their competition to actually know. Okay. And so usually you want to legally disclose as little as possible, and then you kind of get pushed on by your auditors and your lawyers to say, hey, we have to disclose a bit more. So it really depends on usually the relative size of the transaction and the size of any potential liabilities. As an example, if you're buying a company that has significant environmental liabilities, significant pension liabilities, usually you got to disclose that because on the balance sheet, it's going to be considered material, right? But again, I would say of the industrial inkjet deals I follow, if I have a database of 75, 100 deals, maybe 20% disclose the price.
Oh, really? Okay. Yeah. So that is
that's it. So it's really, people fight to not disclose stuff, and they make the argument that, hey, it's just not material.
Let's play a game. If you are a shareholder of any company that is in a position where they have disclosed that they have signed a deal, but it's still not closed, how do you react personally on the information you get?
It's hard, because the reality is that as a shareholder, I want more information. right? I feel like I'm due more information. Right? I buy stocks, you buy stocks, right?
It's
We
your
all
company,
feel like
right?
it's my but for a little tiny bit, yeah. On the other hand, I also understand, having been on the other side of this discussion, hey, if I start disclosing every single thing, first off, I now have to respond to every single thing. And I've got thousands and tens of thousands, millions of shareholders calling me about nickels and what I would consider to be nickels and dimes, right?
So you
And then on top of that,
were so sorry to interrupt you, but you were
yeah,
basically the wrong person to ask, right?
yeah, I'm the wrong person. I'm conflicted on this discussion, right? I'm conflicted. So on behalf of my clients, we shouldn't disclose anything. But yeah, I mean, it's a great point, and it's a huge trade-off. Okay, I think that the materiality arguments. I think public companies in particular are pretty good at making those with their auditors. I think if I'll answer it in a slightly different way. I think the auditors of public companies need to be a lot more thorough than they're being. Okay, we see so many issues with deals, right? Post deal, where auditors didn't disclose something, whether it was deal related, whether it was finance related, whether it was performance related, and you say, hey, how can this be? I've got an auditor, right? That's supposed to be signing these financials every month or every quarter. How the heck did this happen? I would say that as a general statement, I think that the financial world needs to come to grips with the fact that the auditors need to be held accountable. And today they are not held accountable, or I should say, very rarely are they held accountable. Very often, I think public companies, when they don't like the answer from auditor A, what do? They hire auditor B, right? And then auditor A says, oh my God, we just lost $1 million account. Next time, let's be a little more flexible, right? That's the reality of the world. Okay.
And it's funny because you just said before that when we look into the deals, especially the strategic ones, you said that the price was not so important, but apparently the cost of an auditor is very important, right?
That's very important. Why? Because it hits earnings.
Yeah.
Right.
Ken, we have actually talked for 40 minutes already, so I think time flies by, and I think it's been wonderful talking to you. So before we close for today,
sure.
I have more like the fun part of it. I think it's been very fun actually, but the fun thing is in 2 days it's 21.
Yeah.
So what is your expectations for yourself and your company in 21?
Great question. I think 21 is going to be extreme. If I judge from sort of incoming phone calls, right? 21 is going to be a very busy year. I think first off, I think it's going to be a great year for the industrial inkjet markets in general. Okay. Again, as we talked about before, there's going to be winners and losers. Okay. The winners, though, I think much like the stock market, you're going to have this set of winners that far outweighs the losers of COVID. And that COVID will continue to push the analog to digital transition point. I don't think any rational person is going to argue against this. I think the winners, as we talked about a few of them, the packaging businesses, the DTG businesses, the promotional and crafting kind of stuff. Textile continues to grow really well. I'm not sure I want to be in the billboard market anytime soon, but I think the winners as a net are going to far outweigh the losers. For M&A and for myself, I think that, again, COVID is going to drive some of the long-time non-sellers, right? These small, very valuable, privately held companies to kind of wake up and say, hey, wow, that was sort of a near-death experience, right? If that continued on for a few more months, hey, I lose all the value of my company. What am I going to do long-term? And so I actually suspect some of them to now come into the opportunity market, if you will. The actionability of those deals may actually go up. I think on the buyer side, I suspect that the office giants are going to continue to struggle a bit. I think this transition to working at home, if you think about if you're leasing millions of copiers,
yep,
that might not be the business that's going to come back as fast as some of the others. So I think maybe the buyers change a bit. Instead of maybe being the office giants, I think you're going to have a lot more private equity, right? Because these markets are maturing now. They're seeing that these are companies that are going to continue to grow. These aren't just little tech companies anymore. I think you'll also see this transition to what I call the private buyer, the hybrid. Take a company like Bob's, right? In the analog markets, forever big company, profitable, has cash. Well, hey, they went out and did a JV with Radix, which was actually a spin out of Domino, which used to be Graphtech, okay? And they built a JV around it. right? And now they just acquired the other half of the JV. But I think you'll see companies like that are in the analog markets that now realize, hey, digital is here to stay. There's opportunities. I can bring my channel, my expertise, my relationships to the table. And, I think you'll start to see some of them get a bit more active as well. Up till now, a lot of them, I think, have sort of stepped back or have had these little digital efforts. I think you'll see them begin to step up from an M&A perspective as well.
I can't help think about, I think it was I think it was actually before the pandemic. I think it was in the middle of the Xerox HP when that started after the Fujifilm crash. I wrote an article where I was trying to be smart and predict what was going to happen. And I thought that it would be perfect for companies like Heidelberg and Fujifilm to merge because they're both a little bit conservative, but they need each other's technologies. And I think that the offset guys, they need, and I think that, for example, when you look at I think that Komori has been relatively smart on having both the Konica Minolta and the Landa as part of their value propositions. And I think that Koenig & Bauer and Durst seems to be a very interesting setup. And I believe that to some extent that these, let's say, legacy companies, not to step on anybody's toes, but these legacy companies need to find out where they want to be in this market space, because this is a growing market. It is a changing market. And I think that one of the things that we have as a takeaway from the pandemic is definitely that a lot of people, I have interviewed more than 80 people now during the pandemic, and almost everybody say that, okay, the pandemic has maybe not changed the need for digital, but it has moved the digitalization of the environment or of the societies further ahead regardless. And I think that is quite interesting to see how the big ones are going to take on that. And when you mentioned Bob's, I can tell you that we were in Barcelona just 3 weeks ago, filming from their new demo experience center, presenting some of the new equipment, and it will soon be on English. It's a really cool company, and I think it's also a smart move from Bob's that they have taken, the Movent division and put it into a little younger, smarter, more kind of agile setup to have it's more or less on its own. I think that's pretty smart. So it's quite interesting to see where things are moving.
For sure, Morten. And I think what you just said is really important. There's a nugget in there that I want to make sure the viewers hear. It's very hard for a large company like a Bobst or a Komori or somewhere, Heidelberg, let's face it, right? They've had many runs at digital now. It's very hard to run a digital sort of startup enterprise within a huge company, okay? The cultures are different, the goals are different, et cetera. So, having something a little bit outside like a Movent is pretty interesting, right? Because now, hey, that's a business that can be run on very different metrics with a different culture, with different goals, okay? Then when it grows and gets to the right point, then you pull it in. That's a great model. And I think if you look at some of the failures in the past of large companies entering digital, well, trying to run a digital enterprise inside of a very large, hulking analog infrastructure, it's tough. It's tough. So I think you'll see that. And I also think, you mentioned Durst and Koenig & Bauer. I think the ability to do a JV is something unique to private companies. A public company struggles with a JV. How do I account for revenue? Do I get full credit for the earnings? You have all those issues. But hey, two private companies like that, right? Particularly, and I will say this is even more true. I think European companies are much more open to those sorts of long-term relationships than U.S. conglomerates. Okay, I think that's why sort of the Durst and Koenig & Bauer thing is so successful, right? You've got two like-minded companies, long-term goals. They're not fighting over every nickel of revenue, probably, right? And so I think you'll see the what I'll call the analog giants begin to try to figure out how to do digital. I think you'll see more JVs, and I like JVs, right? And then at some point, someone's going to buy the other one out, and that's fine. That's totally fine. Okay, but I think you'll see more of that. I think it helps our industry long term.
Totally agree. New Year's evening, what are you doing?
Well, due to COVID, obviously, it'll be a little quiet. But no, I've got the family here, and we've got a full house. Kids are home from college and things like that. So hopefully there'll be some nice wine and some champagne and some good food. And we'll look forward to a 2021 where we can actually go out and see people at some point. I'm looking forward to that. I'm sure you are as well.